Fundsupermart.com.
Hi, what is your outlook for both equity and fixed income markets over the next 2 to 3 years?
Well, we at HSBC Global Asset Management are strong believers of value investment. And on that regard, we tend to believe that equities offer a much more promising outlook than bonds over this time horizon. For a very simple reason. The balance of risk, both on the upside and downside, looks more promising for equities than for bonds. Let's review the downside risks. Our economic scenario going forward is of a relatively muted economic growth, and we are clearly excluding the possibility of a recession going forward. Maybe in some areas in the world we can see some very weak economic momentum, like in the Eurozone, for example, but overall the world will remain in positive territory in terms of GDP growth. So this moderate expansion of global economy is the best protection against the downside risk for equities. And when you look at bonds, it's pretty much the same situation. Monetary policy around the world will remain extremely accommodative, at least in 2013, but we believe that it will remain the case going forward. And this effectively put a cap on interest rates. The probability of a significant downturn in terms of interest rate is very limited. So for both equities and bonds, the downside risks going forward are fairly limited. What makes the difference is more the upside risk. When you look at bonds, the current valuation is extremely expensive, especially on core government bonds. And by core, I mean US Treasuries, UK gilts, German bonds, and Japanese JGBs. So the potential for capital gain going forward is very limited, precisely because it's very expensive. Now, if you look at equities on a global basis, the fact that the world will keep on growing in 2013, but even more in 2014, makes us relatively positive on the capacity of companies to generate earnings that would be distributed to investors. So the upside risk for equities at this juncture is a lot more promising than for bonds. So against that backdrop, we tend to favor equities versus bonds. Now, having said that, we also have to go much more into details because the bond universe contains several segments, and I already mentioned that we are fairly negative on core government bonds, but we remain positive on the credit universe, precisely because even if yields have tended to decline recently and the credit spreads are relatively narrow, have compressed over the past 12 months, there is still room for further credit compression in the course of 2013, meaning that investors could still generate a positive return on credit, both in emerging markets and developed markets. Now, so our strategic position with regard to credit is clearly positive, but we are entering into a moment when investors need to be fairly selective of the bonds they buy, especially in the credit universe. This is due to the fact that spreads normally compensate investors for the risk they take. And at the moment, these spreads are fairly low. There is room for further compression, I insist on that, but clearly the compensation to the risk you take is not as high as in the past. So investors need to be selective and favor issuers with a fairly liquid balance sheet, meaning with a low level of leverage, and also issuers with a strong capacity to generate cash flow, because these two features are the best insurance for investors against the risk of default. And that would be extremely important going forward for the expected return of a bond investor. So this is by and large our vision for 2013, a positive bias towards equities. We remain very cautious with core government bonds, and we still see some potential, but more limited than last year on the credit market.
The US equity market rebounded strongly after its government successfully averted the fiscal cliff situation. Do you expect this positive performance to continue? And what will be the main performance drivers for the US equity market?
That's absolutely correct that the equity market in the US reacted very positively to the announcement of this partial agreement on the fiscal cliff issue. Now, our concern going forward is that we are still facing some hurdles related to the fiscal cliff, especially related to the spending cuts that hasn't been really addressed in the agreement of the 1st of January. And we will see some market nervousness, some volatility as we approach the time when the Congress will have to negotiate with the Obama administration, probably in the course of March, April, potentially May. So in the short run, investors should expect some nervousness on the market with regard to the prospect of the US economy. But it's important to bear in mind that if you go beyond the usual political posturing, which is typical of these kind of events, the negotiation between the Republicans and the Democrats, the economic costs of not reaching an agreement on the fiscal position and also the debt ceiling issue far outweighs the political cost of reaching an agreement. And we believe that at the end of the day, we will have the same kind of 11th hour sort of agreement. And this would definitely prove positive for the US economy and by extension to the US market. Having said that, there is also another factor to take into account when assessing the prospect of the US equity market. It's the evolution of the private sector in this country, because investors have focused their attention over the past couple of years on the public sector problems, and there are a huge number of them. But we should not overlook the convincing improvement made by the private sector in terms of rebalancing their financial position. Businesses have maintained a fairly high level of profitability, and their level of leverage is actually at a very low level. So basically, they are not facing the same kind of constraint as the government. But the most interesting evolution is actually on the household sector, because when the financial crisis started in 2008, US households were particularly constrained in their expenditure, given the fact that they had to support a high level of debt payment as a share of their disposable income. So they were constrained in their purchasing behavior. The most recent data available from the Federal Reserve show that the situation has improved dramatically. And when we compare this debt payment as a proportion of disposable income for households, tremendous progress took place over the past 4 years. And basically, households gained 4% in terms of fund available for consumption out of the debt payment obligation for this part of the economy. So basically, as we enter into 2013 and more likely 14, the US household sector will become more important in supporting growth. And that's probably what can drive the market in the next couple of years. The fact that the US consumer is showing some signs of life. And this is also highlighted by the convincing improvement on the property market. You've probably seen recently the very strong performance of housing starts, which are currently at the highest level since June 2008. And it's a very encouraging sign for the US economy, because the decline in the property market triggered a massive negative wealth effect for US households. And the fact that prices are now again rising is an indication that soon positive wealth effect might re-emerge. And this also comforts us in our view that the US economy is probably going into a more positive dynamic in the next couple of years.